you so much, dear. I just, thank you so much. I remember being in this room so many times before, so thank you for bringing me back.
Absolutely.
Oh, it's been, how long have you known each other? Like a decade or something like that?
Yeah, a decade.
When I first came and spoke here, it was a different world, obviously. I mean, I started uDirect IRA Services in 2009, and of course we were all experiencing the recession, and we were all wondering, well, where are we going to get money for our deals? And I think this is when self-directed IRAs kind of rose to the forefront, because you couldn't get money from banks. Banks just were not lending. And if they were, usually you could get 10 loans. You could have 10 loans out at a time, but now that was reduced to 6 or fewer. So that's when people started to realize, oh, everyone's looking around, where can I find money? Where can I find money? And they realized that self-directed IRAs were the place, that's a place to find money. And so I'll be going through this presentation tonight. And what I want you to think about is, one, are you raising capital? Because if you're raising capital, then you can use other people's self-directed IRAs to raise that capital for your deals. It's awesome. And it's sort of a win-win situation. Well, it is a win-win situation. You know, have your deal financed, and then they receive a return. Yes, did you have a question? How do you do that?
Yes.
I am fixing to tell you.
Okay.
Okay. By the end of the night, you will know. I will tell you all.
Sorry.
No, it's great. I love it. Any questions, just let me know. It makes it interesting for everybody. And so it's not just being able to use other people's money, but it's also the ability to use your previous employer's plan. Like you said, your husband has a pension. So what you do is you contact your pension administrator. You say, hey, I want to move my money, and that's a process called a rollover. We can walk you through that process. But you've got this money. Where do you want to put it? I mean, do you want to put it in the stock market? Maybe not today, right? We see how volatile it is. And I think you were saying about that it's a changing market. But every time I've been here, it's been a different kind of changing market. It never stops changing. So the nice thing is, if you don't like it now, hang out. It'll be different later. But we all need to learn how to make money in every cycle. That's one of the reasons I love running OC RIA too, is because I talk to people that, like last month, somebody who's been in it 35 years, always, okay, it's a new cycle. What do we do in this cycle? How do we make it work now? And being able to shift. So what a self-directed IRA does, again, is helps you, raise capital. It's a source of capital, and it also helps you to, grow your own personal wealth. So, saving for retirement is so incredibly important. So few people are truly prepared for retirement, and I love how Christina was talking about insurance. I mean, and there are many different kinds of insurance, and then there are so many different kinds of products. But I think what we see people doing is layering their retirement, and they've got some Social Security, they've got some 401k at their job or something, and maybe they have insurance or an annuity or something, so that they just have multiple streams of income in retirement. And a self-directed IRA can be one of those multiple streams of income. It is self-directed, so you've got your hands in the pie a lot more than you would a stock investment, where somebody else is making the decisions for you. But with a self-directed IRA investment, you have just so much more choice and freedom. So this slide explains that there's a gigantic deficit between what America has and what we need to retire comfortably. So if you have $100,000, you might think that's a lot of money, but it really isn't. If you were going to retire at 59 and a half and you knew you were going to live until you're 86 and a half, you'd only have $400 a month. And right now that's 4 tanks of gas, am I right? So we really need to think about the future, and that's what's great about this club and all the other clubs that Christina mentioned, is because this is where you learn the techniques of how to do the investing, how to do multifamily, whatever it could be, so many different things. Performing and non-performing debt, take your IRA and loan it to someone and be the bank. Private placements, you want to be a GP, right? And who wants to be, you want to be a GP. And so then you're raising capital. It just helps in so many different ways, but you're going to need more than $100,000, I promise. Okay, so we could update this slide a bit this year. I think it's closer to 40 trillion now that's in American retirement accounts. $40 trillion in American retirement accounts. Wow, right? A lot of it is in IRAs because people have changed jobs and moved from defined contribution plans like 401ks and DB plans into the self-directed IRA or other kinds of IRAs. So it's around, I'd say 13 trillion is now in IRA accounts. It's just a tremendous amount of money. So if you are raising capital, again, this is one of the very best places to find it. because you're really helping someone build their retirement, right? Nobody wants to be that old person at the grocery store with only enough money to buy like, one banana. You want to have a really healthy, robust retirement, and that's what we want for you. And that's why Christina and I spend our lives and are dedicated to teaching people how to have a better life, All right, so 40 trillion, that's a great number. If you haven't heard about self-directed IRAs, Tyler and I were driving up in the car today, we're talking about this, and I've been speaking about it for so long, it seems to me that, everyone knows. And so Tyler's new to it, and he's like, well, I don't think everybody knows, so there's still an audience. I think a lot of Christina's audience has heard me speak several times and really understands this tool, just like we understand mortgage as a tool. It's similar that it's just another tool in your toolbox as an investor, right? And I'm going to explain the whole thing to you. But I'll tell you what, this is nothing new. These rules have been around since 1975, right? Longer than a lot of people in this room have even been alive. So it's just nothing new, and it's been tried and true. If you remember Gerald Ford, then you're old enough to remember when this started. The ERISA laws, right? Employment Retirement Income Security Act, ERISA, 1975, started IRAs. So when IRAs started, they didn't create the self-directed IRA then, it was always just one thing, it's an IRA. And that's how it is today, it's one thing, it's an IRA. But what makes it self-directed, and we'll get to this, I think, probably next, is the kind of asset, the kind of asset that you put into that IRA bucket. So if you're working with a financial advisor, and somebody's got a 763 or 6 or something like this, 63, whatever number it may be, up to infinity, to become a financial advisor, they can only sell you market correlated assets. They can only help you invest in market correlated assets. In fact, I was looking at it at one point, and I was going to have to relinquish my real estate license if I was going to go forward with this. It's like, I don't want to do that. So just know that you've always been able to invest an IRA in any asset except life insurance policies and collectibles. Everything else is acceptable, okay? Life insurance and collectibles, everything else is just fine. So it could be a lot of different things. It could be, let's see here. Yeah, we'll talk about this in a second, but I just want you to know it could be, you can invest in precious metals as long as they meet this high quality of purity, and a lot of people are doing that right now. A lot of times metals are a great hedge against inflation. We see so many people investing in notes. Notes are a huge asset where they're lending money or buying performing and non-performing debt. And private placements in the industry is probably the #1 asset class for the whole industry, is to just be a small part of somebody building a big project. And your IRA is either a debt or equity partner in that deal. Very exciting, and you can see some real returns, and every single deal is different. All right. So when it comes to self-directed IRAs, you see it's a really great tool because, again, other people's money, your money, all these different alternative asset classes, awesome. And it's a way to get out of the market, like where a lot of people wish they were today. I think, how much have we lost? We've lost, it's up and down every day. I think today was 2.5% down. So when you're riding a roller coaster like that, you might like to be invested in a ship that's a little bit bigger and a little slower to turn around, like an apartment building, for example, and you can do that with the self-directed IRA. If you invest though, and you lose money, you need to know up front like how this works. If you're going to play the self-directed IRA game, what are the rules? And the rules are don't lose money. That's one of the big rules. And so you've got control over that to a degree. You've got control over by doing due diligence. And I know Christina talks about that quite a bit, doing due diligence. Understanding the contracts, what do they really say? What are they promising you? What are your obligations? If you're investing in a private placement, is that private placement taking on debt? And that's something to be thinking about. And there are just so many different rules, but learn to do your due diligence, because if your IRA does invest and that asset doesn't pay off, then you don't get to write that off. It's just a loss, right? And so it's difficult to recoup losses in an IRA retirement account. So just always do your due diligence up front. Ask people too. If you're investing with someone, talk to other people who've invested with them, and say, hey, you've invested with them. How was your return? How was your experience with them? Did they return your phone calls? Did they answer all your questions? And, Google them. I have a good story. We had an account holder who she moved over a big account, and she was going to invest. And so she invests $500,000, which, by the way, when you can only put, like, in that time, maybe $2,000 to $3,000 a year into an IRA, she had a pension, though, so she could put in more. But that's a pretty big retirement account because you've got contribution caps. She had $500,000. She was going to invest that $500,000 for all you real estate investors into real estate unsecured. Who would do that? Anybody? No. So did she do her due diligence? Do you think she was a sophisticated investor? No. But if you're going to make a note for $500,000, $500,000, that is not just a note, it's a security. And you have to be what's called an accredited investor to invest in that. I'm sure a lot of you know what an accredited investor is. It means you have a certain income limit or a certain net worth, right? So when we talked to her, anyway, in the long story short, she ended up not doing that deal. And good thing, because who would give $500,000 to someone unsecured in real estate? But what we found out later, as we peeled back the onion, the people she was going to invest with had actually been, I'm not kidding, incarcerated for 2 years for stealing money from people's IRAs and other things. So if she had done her due diligence, gone online and typed their name and the word fraud after, she would have known that she was dealing with actual people who are actually, convicted and served time, through the SEC's, invitation. So you want to do your due diligence. So the limits. All right, so we talked about this a little bit, but what you can do, anything except life insurance contracts and collectibles. So no fine wine collection because it ends up being a bottle collection, right? No numismatic coins, which are like the collectibles, or it has to have a really high level of purity. Like a Krugerrand doesn't have a high enough level of purity to be in an IRA, right? You'd be surprised. But stamps and all these different things. Question, yes? You cannot invest in, it's just the two things. Life insurance contracts and collectibles are disallowed. One time I had somebody come to me and they wanted to move their account over to us because their current custodian kicked out their life insurance policy, and he brought it to me. Literally a life insurance policy. It's like, this is the thing, the very thing you can't put in an IRA. But somehow he had used a retirement account and they put it in there for him, but we couldn't take it. Disallowed. So I think no self-directed IRA talk is complete if you don't talk about the rules, because it's just not like investing your own money. Like if you want to invest your own money, you just write a check, you do whatever you want. With a self-directed IRA, you get this tax protection from the IRS. So you want to make sure that you follow the rules. So one of the places to find the rules is on irs.gov, publication 590. So 590A talks about getting money into the IRA. 590B talks about getting the money out, and maybe dispersing it. It could be when you're 59 and a half and you can disperse it without a penalty. It could be now the RMD age is 72. When you're 72 now, you have got a required minimum distribution that you must take out. All that's explained in irs.gov, publication 590A and B. So basically with a self-directed IRA, you don't borrow money from an IRA. You can from a 401k, but not an IRA. You don't use it to invest in anything you personally own. It's not security. If you're going to get a mortgage, you can tell them how much you have in your IRA, but it can't be security. And you don't ever use it to buy property for personal use, either present or future. But what you could do, say for example, you want to buy a house or you found a condo or something like this, and so your IRA buys it. And then later in retirement, you think, you know what? I've had this place in my IRA for all these years. I think I really want to live there now. I like that place. What you can do then, but you can't just go live in it. What you need to do is get an appraisal, give us the appraisal, and withdraw the asset from your account. And then you'll receive a 1099 at that market value. So you want to probably do it during a low income year because you'll probably get hit. But you can take a personal property out of an IRA and hold it personally in that way by, again, getting an appraisal and withdrawing it and then getting taxed, right? Here we go. All right, so more about the rules. Some people are qualified and some people are disqualified to the IRA. And I don't think there's really anywhere else where this applies. But a disqualified person is your close family, your ancestors and ascendants and descendants, your parents and grandparents and their spouses, you and your spouse, and then your children and grandchildren and their spouses disallowed to your IRA. So I'll explain how that works. Also, a 50-50 business partner is disallowed, and anybody who's a fiduciary, like a realtor can be a fiduciary. They have an agency relationship with you. They're a fiduciary. So, okay, then the qualified people can still be in your family, though. They're just out to the sides on the family tree. like cousins and brothers and sisters and aunts and uncles, they're fine. It could be like, so this is all going to come together. So now you know who can play the game, right? Some of the rules and who can play. And this is how it works. It's a game of keep away from prohibited transactions. This is how you win. Stop in the name of love. You know what I mean? So you don't want to commit a prohibited transaction. So neither you nor any other disqualified person, because you're disqualified to your own IRA, can have use of the property. For example, you cannot have any personal use. You cannot benefit personally today. It's all for retirement. Retirement accounts are all about later, not about using the money for today. So neither you nor any disqualified person can benefit either a direct benefit or indirect benefit. So I'll have a lot of people say, well, what if I have my IRA sell this property to my LLC, and then I do, it's like, no. If you can't do it directly, you can't do it indirectly. You know, investors are really smart people. You guys come up with lots of amazing ideas. But here you got to follow the rules, and I'll tell you why. But you don't buy, sell, or exchange assets between the plan, the IRA or the 401k or whatever, and any of those people. So you don't sell an asset say your IRA owns to like your children. You don't buy, your IRA doesn't buy a property from your parents' estate, for example, because they're disallowed people. It would be a prohibited transaction. And then lastly, these disallowed people, right, up and down the family tree, fiduciaries and so forth, they can't provide services to the plan. So here's what this looks like. We had somebody buying real estate, and we're looking through the offer to purchase, which is like, how thick is it now? How thick is that thing? It's crazy. The lawyers add a page every year at least. But so we're looking, we get to the back and we say, hey, look at this name, look at this listing agent. Has the same last name as the IRA holder. Wait a minute, what's going on here? Are they related? Well, they were. And so what it was Dad that was a listing agent. So Dad was offering services to the plan. So even if Dad didn't want a commission, it's still a prohibited transaction because he is offering services to the plan. Get this, it's an overcontribution of sweat equity. Do you love that? It's his effort that creates value. And it's true, it does. So he couldn't do it for this reason, but Dad also couldn't, do that deal or be the listing agent because he wanted a commission. And that would be a disallowed person receiving benefit from an IRA asset. Kind of blows your mind, right? So that's why one of the things we do all day. Tyler he's been training with us in sales for a couple months. And one of the things we do is we talk to people all day long for like 20 minutes. Tell us, what are you looking to do? What kind of account do you have? But tell us about your deal. What's the structure? Who's involved? Who are the principals? Who's involved? Are you looking to take on leverage? We want to hear because if your IRA commits a prohibited transaction, it's just game over. Your IRA, the balloon of the IRA, the protection bursts. Now it is just your money and you get 1099 on that, maybe penalties, excise taxes and penalties possibly. So you lose the tax protection if your IRA commits a prohibited transaction. So that said, I'll tell you that in my 15 years in this industry, I've only seen maybe half a dozen actual prohibited transactions. But if we see something where somebody wants to commit one, we'll cut that off. Or if we run into one, we'll let people know what they have to do. But the IRS actually calling someone out on a prohibited transaction is a different story too. And if you do that, it is game over. So you want to be real careful. And that's what we want for you, and that's what we spend a lot of our time doing, is hearing what people's deals consist of. I could tell you a story. I think I've got a little time, so I'll tell you a story about this. I've got so many, but I was speaking at one of the Norris Group events, and it was a brunch, and I'd been speaking to this nice couple, and then they showed up and they enjoyed the brunch, and afterwards we sat down. They have like penmanship, like architects, like you just love to look at, so beautiful. And they both have their manila file folders. They're so precise. They have everything. They each have an IRA. Each of their IRAs has an IRA-owned LLC. I'll talk about that later, like a special purpose LLC. They're so dialed in, and they're going to buy this property. They are so excited. And so this is a commercial property, and they're telling me about it and what it's worth and how they got it and what they're going to do with it, and they're so excited. And then we've been talking about half an hour. It's like, wow, that sounds great, And then they casually mentioned, yeah, and we own the building right next door, so we can be there all the time. Like, oh no, balloon burst. Why? Why do you think? Why is that a prohibited transaction? Why? How prohibited is it? Okay, it's a prohibited transaction because They own the property next door. And anybody who's a real estate investor knows if you own this property and you buy this property and fix it up, it's going to affect the value of this property. So by improving this property, they receive indirect benefit. Their IRA is going to benefit from, you see how that works? So, and if they'd done it, they could have gotten in trouble. There was actually a court case recently that covered that very thing. It was after I talked to them. So they just found another deal to do. They bought that one personally, which was a better idea, so that they didn't have personal benefit. Okay, so if you're going to play a game, you need to know the players, who's on the court, right? So there's you, and that may not be you, but that's just a person. And then your IRA is a tool in your toolkit. It's a tool in your tool belt. Then there's uDirect, IRA Services, the best company in the world. Okay, woo! All right, good. Thank you. And we have just under $1 billion in client assets. Yeah. I need a cat now. And when I founded the company in 2009, I enlisted the services of a trust company custodian, and they serve as our back office. They hold the money, they do the cash management, and so forth. And they'll do some of the regulatory reviews of the accounts and so forth. So these are the players in the self-directed IRA game. All right. And so buying real estate with your IRA. Hey, that sounds like a great idea. Let's do it. We're a real estate investment club. Let's do it. But only to be fair, I've got the pros and cons up here, because it's not just fair to say that this is great all the time. You have to be responsible and be aware that you could make mistakes, and that's why we're here to talk to you. But so first off, you buy real estate, any gain comes into the account tax-free or tax-deferred. Sweet. Who likes tax? No one. Positive cash flow, all the rents and so forth, tax-deferred, or maybe you've got some vending machines or something like that. It's also going in there without being taxed. There's no time limit for holding the property. If you've ever done a 1031 exchange, you know that you've got only so much time to make it happen. The clock isn't ticking in an IRA like that, so that makes it really attractive. Your IRA can borrow, or your 401k too, can borrow money. That's really cool, and it's a special way to do that. I'll talk about that. But what I really love is that there's this potential to earn a larger rate of return on your money, right? Because the proceeds that come back in the IRA aren't diminished by tax. They can immediately roll out into the next deal, you see. So now you just made all this money, not diminished by tax, so 100% of it goes out into your next deal and compounds and compounds and compounds as you go through life and you continue to invest, as hundreds and thousands of our clients do. Okay, the downside, do I have cons there? I still have pros. The downside of investing in real estate using a self-directed IRA may be that you could get better tax advantages buying it personally, right? So you want to take a look at that, talk to your advisors, say, hey, look, I've got, you might say, I've got this retirement account over here from where I used to work, and I've got a whole bunch of money over here. And which one do I want to use for this deal? Well, they may say, hey, take this one personally because you're going to get all these write-offs. It's going to be great. But if you don't have a lot of money personally, maybe you just left a job with a big 401k or something, 403b, 457, you leave that job, and now the question is different. It's, do I invest in real estate or do I put it in the stock market? Right, exactly, yeah. So, and if you're here, you're a real estate investor, so you know what real estate can do. As long as you understand the alternative asset class, it makes perfect sense to invest in what you know best, like real estate, right? All right, so there you go. You're solely responsible for any gains and losses. We're not advising you what to invest in. And of course, we talked about how when you lose money, it's difficult to replace. And what else here? Yeah, the tax advantages. You don't get to take deductions when your IRA owns a property. All right, so those are things to know from your income tax. All right, now, this is pretty cool. My background, I didn't even tell you about my background. What was I first? I was a radio announcer, which made me eminently qualified for this job. But in my 20s, I was in radio, and then I made the logical leap into real estate. And I became a property manager in Seattle, and I managed a little building, a little bit bigger building, a little bit bigger building, and got really good at that. I really liked it. And then, long story short, I got engaged and married, and we moved to LA. And then I got into mortgage loan servicing, and I stayed in that for a long time, which is so much like what we do at uDirect. I like account-based, work and cash management and things. And then I got into loan origination before I got into self-directed IRAs. So I was a residential loan officer. So when I found out that your IRA could get a loan, a bank would make a loan to an account, I was blown away because I was so, in my little, residential lender box about what the rules were. Yeah, your IRA can get a loan, and it's made to the IRA. It's really made it entirely regards the asset. So the underwriter is going to look at location, condition, but 100% is going to be looking at cash flow, right? Cash flow is king. So you need to have a rental agreement in place typically to get one of these loans, but you can get one. Now, if your IRA were to default on the loan, they couldn't come against you personally. It's non-recourse. They couldn't take any other assets in your IRA. All they could take is a subject property. And if you'd like, we have a list of non-recourse lenders we would provide to you. It's not people we necessarily endorse, but it's really hard to find them. So we, as a courtesy, have created a list. Yes?
Do you find the non-recourse loan, the interest rates are as volatile as a typical lender?
Yeah, he wants to know about interest rates on the non-recourse loans. Yes, they're just as volatile because, yeah, it's based on risk as well, and it comes basically from the same source. So, a lot of times though, these are portfolio loans too. Yeah.
And you can refinance a non-recourse loan, right?
Yes, you can refinance a non-recourse loan. Yeah, you can.
If you put a property in a self-directed IRA, can you ever find a way to refinance it and buy it out of your personal account? So if you want to switch it from an IRA to personal, or is the only way to do that to pay the tax on it?
Right. So, the way you start off with, you never put in a house in your IRA. Your IRA acquires the asset. So that's how. It's not like you could have a house and put it in there. I just want to be super clear. But so if your IRA were to invest in a property and you want to refi it, you could never have personal use of it from an IRA loan. That would be, self-dealing perhaps, or it would just be prohibited because you're crossing that barrier between yourself and your IRA. So your IRA isn't going to take out a loan that you have personal benefit of. Prohibited transaction. Okay? Yeah, it would be nice if it worked that way. Like I said, investors are smart people, and we always want to come up with a way to do it differently, but that would not work. We've also had people go to their banks and try to get a Freddie, Fannie, conforming, whatever kind of loan on their IRA property, and we've had one of them got all the way almost to closing until the lender realized, well, wait a minute, this property is going to be owned by an IRA. So the IRA holder was not really upfront about the situation, and once they realized it, the deal was over because there isn't recourse against an IRA for a bank, so they're not going to make that loan, okay? But you can get a loan from a non-recourse lender. Now, prohibited transaction, personal guarantees, I would just want to throw that out there. So you don't personally guarantee a loan made to your IRA because that would be offering services to the plan. But this is the point we're getting to. When your IRA borrows money, it can be great. We all know about the power of leverage. Wow, I mean, it can be so powerful and so great in accelerating our net worth, and it's a beautiful tool. But understand in an IRA, it's a different kind of microcosm here. So in an IRA, so your IRA invests, right, and you use leverage. The proceeds that your IRA earns due to leverage are taxable. It's not income tax. It's called UDFI, unrelated debt financed income tax, okay? So here's what this looks like. I say, for example, like you found a property for $100,000. You could still do that in some places, I think. And just for numbers' sake. And your IRA had, well, you need to leave a 10% pad. We'll throw that in there. But say your IRA put in 70 grand and your IRA borrowed 30 grand, right? So it's 30% leveraged. Now here comes your rent check. You get a $1,000 rent check. Well, $700 of that your IRA earned because of savings. But $300 of that your IRA earned because of debt. So it's unrelated to the IRA, so it's unrelated debt-financed income tax. Your IRA earned the income because of debt. And so that's taxable at a pretty high rate. But this is an exception to the not being able to take a deduction thing we were talking about. You have your tax person create a 990T every year, and if there are expenses, they'll deduct them. And you may not end up owing any tax if there are expenses. So this is something to discuss with your tax person. And it's a lot to know. This is a good cursory view, and when you want to go deeper on it, when it's something you're doing, call us and we can go deep on it and really explain it. And I'll answer any questions you have tonight. Are we good?
We're good.
All right.
Okay.
Thank you. Okay, there's a twin tax, or like a cousin tax called UBIT, unrelated business income tax, And this comes into play if you were to invest in an active business. Like if your IRA were to like maybe buy a franchise, that's an active business and there's an extra tax. And why is this? Like why would that be taxed extra? It's kind of like, it all started like with so many other things with the Catholic Church. So say you're the Catholic Church, you're exempt, tax exempt, and maybe you open a bakery, right? Because you're the Catholic Church, you're going to sell some baked goods. Sounds really great. But then like somebody across the street opens their bakery. Well, they have to sell their goods for more because they don't have the tax exemption. They have more expenses, so they have to charge more. So the tax-free entity has an advantage. So this tax levels out the playing field, you see. So it's unrelated business income tax. So we don't give tax advice per se. We're not tax advisors and we're not lawyers. But you can read about these two twin taxes at irs.gov publication 598. Or just again, call us. Yeah?
There's a guy by the name of Damian Lupo who advertises an AQR. He says if you invest in a self-directed IRA into a real estate syndication,
Yeah.
you have a big tax bill coming due to the UBIT tax, but his EQRP can steer you away from that.
I'll explain. Number one, there is really no such thing as the EQRP except that Damian Lupo made it up. So what it really is a solo 401k. I mean, God bless him, he's all over the place. So that's great for him. But it doesn't, you're not going to look in the tax code and see an EQRP. It doesn't exist. It's just a different way of naming a solo 401k. And he's correct. If you have a solo 401k, which is not an IRA, and your solo 401k invests in real estate like an acquisition and takes on debt, that debt probably will not be subject to the UDFI tax. Okay, now, but you also talked about private placements. If you're going to invest in a private placement with a self-directed account, be it 401k, IRA, HSA, whatever it is, you want to ask that asset sponsor that you want to ask them, is this capital raise, is this Reg D offering taking on debt? Now, if they say no, we're not taking on debt, it's all equity, great for your IRA, awesome. That's what you want to be in, I think. But if they say, yeah, we're taking on so much mezzanine debt and blah, 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 this is our capital stack, and you're kind of daunted by all that. And then, so if they're taking on debt, then yes, when your IRA will get a K-1 from that asset sponsor at the end of the year, whenever it comes out, like January, and then it'll say how much it should be subject to the UDFI tax. So it's true. And whether you have an EQRP or a 401k, you're still going to have to pay tax on it. Just because it's a solo 401k doesn't mean you get away from that kind of tax. You have to understand and talk to your tax advisor and verify with them that UDFI, it's not if you have a 401k that you never have to pay UDFI, you might. And it might be in the case of a private placement. So you want to discuss that with your tax advisor.
Are the loan requirements the same for a self-directed IRA as they are for a solo 401k?
The lending requirements, yes. Yes, they are. We don't provide that lending, but I've got a background in lending, so I can talk about it. But at the same time, yeah, they are the same. And it's all about the asset and its cash flow. Like that's primarily what they're going to look at.
Yeah, well, he never mentions it's a solo 401k.
Like he invented something new. I know. Well, okay. Yeah, okay. So it's been around for, what is it? 401k has been around longer than an IRA. So that's something that's been around for a tremendously long time. You just repackaged it. But it helps people. If you're using one, great, because if you're saving for retirement, that's great, right?
Yeah, no, I contacted him. I heard him on the Real Estate Guys Radio podcast.
Uh-huh.
And so they had a free book, so I sent it in, I got it, and I was reading it. I said, to me, it's exactly the same as a solo 401k.
It is a solo 401k. Yeah, precisely right. Yeah. So, well, like I say. Well, so there's something else that you may have heard of, a checkbook IRA. So has anybody heard of that, checkbook IRA? Yeah. It's kind of a misnomer. A lot of people will call us and they assume that when they open a self-directed account with us that they get a checkbook IRA, they get a checkbook with it, like a gift with purchase, right? And you don't, I promise you. What it really is an IRA-owned LLC. And what it really is an asset that your IRA or solo 401k will buy. And here's how it works. You have a self-directed account, whatever it may be. You fund the account by a contribution, rollover, or you transfer. Now there's money in there. You have a third party create a special purpose LLC. Now it can't be you. A lot of people will say, yeah, I just created an LLC and now I want my IRA to buy it. Well, remember the prohibited transaction rules. Your IRA can't buy an asset you own. So it has to be your IRA is open and exists. A third party creates the special purpose LLC. Your IRA or account buys 100% of the initial units. That's important. 100% of the initial units. Great. So now the money goes from the IRA into the LLC's checking account. And now you've got checkbook control of your IRA money. Does the IRS like this? Not a whole bunch. When they get a lot of money to do audits, like remember the Build Back Better Act, they almost got $80 billion to do audits. We came that close. When they've got more money to do audits, guess what's first? Because there's a lot of low-hanging fruit in these, and they'll probably find a lot of prohibited transactions. So if you're going to use a checkbook IRA, use it carefully, talk to us. Make sure that you're keeping careful records. I recommend Quicken if you just want some light bookkeeping there, but that you've really detailed everything. Make sure that every expense is for either a direct investment or for the expenses of an investment that the LLC owns. And that's it. That's it. Yes?
Can you transfer those type of LLCs to somebody else, like if they were going to assume your loan, to avoid an origination fee on transferring a loan to them? Like let's say you have a low interest rate, like 3.5%.
Yeah.
You want to transfer that to the buyer so they can give you a better offer.
Well, we're talking about two different universes. So that would be no, because anything that's a conventional conforming kind of a loan doesn't belong in the IRA world. So that would not happen.
So they can't, nobody else can just grab or transfer that LLC or purchase that LLC?
Correct. It's IRA owned. And it's a special purpose LLC. It's written with special language in the operating agreement saying that the purpose of the LLC is one purpose, and that's to act as a conduit for the IRA. And that is the only purpose of that LLC. So this isn't something you do on LegalZoom.com. It's a great question, It's not something you do on LegalZoom.com or prepaid legal or something. You want to have a professional draw this up so that it's correct. Again, investor, clever idea, doesn't work in the IRA world. That happens a lot, Okay, so we talk about the self-directed IRA, and as we've been talking about tonight, it really is a lot of different things. These different accounts are typically not self-directed, although the defined benefit is self-directed by nature. A DB plan can self-direct. You don't have to open a self-directed account. A defined benefit plan can, by itself, invest in alternative assets. Profit sharing, so these, we don't provide these. These are employer plans for companies with more than one employee. A solo K, we do. The individual K, solo K, 1K, whatever you want to call it. That is for somebody who is self-employed with no full-time employees in any of the companies that they own. Then you get this. It's got a lot of special benefits. But with the IRAs, it's the traditional Roth, SEP, simple, spousal, inherited. All of these IRAs are self-directable. And over here, we don't offer the Coverdell. We used to, but it's just too teeny. It's only $2,000 a year. They're so small. But that we've recently started up, once again, offering the health savings account, the HSA. So if at work you get a high deductible health plan, then you can have an HSA. You've got contribution caps, but you can self-direct that money. Pretty cool because the money comes in it goes in like a traditional IRA where you get a tax break going in, and it goes in like a traditional, out like a Roth, like March, in like a lion, out like a lamb, right? So it goes and then you get like the best of all worlds. You get a tax deduction for putting the money in. As long as you spend the money on qualified health expenses, it comes out tax-free. And there's some good stories about that. So all of these are self-directed plans. It's not just an IRA, although I'll tell you what, 90+% of the accounts we hold are traditional IRAs, mostly because people have employer plans that are pre-tax, and a traditional IRA has the same tax treatment, so it goes over to traditional, okay? So how do you do this? Like, okay, I've heard some rules and what to do, and first off, you want to find your asset. You want to, first, I don't even have it here, but you want to educate yourself on what asset class you like. And this meeting, Christina's meetings, and everybody's meetings that she mentioned are just such an amazing free source of information. Okay, great. Now you know what you're going to do. So you open an account by completing an application. We have a $50 setup fee. It's a flat fee of $275 a year, probably the lowest in the industry. We don't upcharge you like plus $100 for real estate. We don't do that. It's a flat fee, and there you go. So yay. It takes about maybe at the most 24 hours to get your account open, at the most. But then you get access to your online account, and there you go. So now you're going to fund that account. You're going to put money in it. So you can contribute, which is based upon your age, your income, and your account type, how much you can do. Transfer an IRA to IRA, that's called the transfer where you fill out our form. You could roll over a previous employer plan, like your husband's pension. A lot of people have left their jobs. What is it, the great walkout or the great reset or whatever it is? A lot of people have left their jobs and left 401ks behind. They can all roll over into a self-directed IRA and invest in alternative assets. So great, so you open it, you fund it, now you invest. You say, hey, this is what I want to do. So you give us a direction of investment, which is basically just a few bits of information, who you are, what you want to invest in, how much money, that sort of thing. And you give us the supporting documentation, which is the contract, like a private placement or subdocs or something like that. Or you give us the offer to purchase if it's real estate. Or if it's precious metals, then you're going to give us like an invoice to purchase those precious metals on behalf of your IRA. Whatever it is, you give us the supporting documentation. We review, fund, disperse the money there, fund it, and now you've self-directed. And 100% of the proceeds that are due to that asset have to go back in the IRA that owns that asset. We have had people take their IRA, like they've had someone, it happened twice, they're both lawyers, it was like the same week, it was crazy. But they both bought houses and they both took their rent payment and put it in a different retirement account thinking it was okay. It's not okay. You have to put it back in the retirement account that owns the asset. Similarly, if you have expenses, all the expenses of the asset have to be paid for by the IRA. Your account fees, you can pay them out of pocket, that's great. But as far as like if you've got a property and you have to pay property tax, has to be paid for by the IRA. So that's why we have you leave, when it's real estate, have you leave a 10% pad in there. Yes?
Is your individual K program another name for a solo 401k?
Yes, it's all the same thing. 401k for a single employer. That doesn't really trip off the tongue.
Does it have check writing privileges in it?
You mean, does it come with an IRA-owned LLC as a gift with purchase? It does not. But you can obtain one probably for less than what another person might charge you. So again, no account comes with a checkbook. It doesn't do that. If you're going to use the IRA-owned LLC, you create the special purpose LLC. But you can have check writing authority as well. Okay? All right. There you go. So yes, 401k, there are a lot, like I said, there are a lot of different names for it. Solo K, individual K, all different. It's just a 401k for an individual employer. So there we go. Open, fund, invest. That's how you do it. And that's me when I had my hair done. And that's how you get a hold of me. Yes?
Okay, I have a question because one of the reasons why I was excited to get you on the schedule was there was, at one point, a policy that was looking at being put in place, an actual code or bill, which was that if you used IRA funds to invest in real estate syndication deal, that would be prohibited.
Oh.
What was that?
Okay,
And
yeah.
what happened to it?
Okay, first off, let's put your anxiety at ease. It died. It didn't go anywhere. It was the Build Back Better Act. So they had this act, right? Of course you must know about it because it was how many trillions of dollars. It was an act with 146 separate sections. Who could comprehend not just that many sections, but the unintended consequences and who it's going to affect? And so two of the sections impacted retirement investing. One of those sections would have said that it would have eliminated the IRA-owned LLC, for one thing, and it would also have stopped syndication investing altogether. Just terrible. And people, when you get into a syndication, it's not like an in and out deal. A lot of times it's a slow burn, right? You get in and you could be in there for 10 years, right? And before you see, because everyone's taking the risk together of that project coming together, right? And then when it does, then you see the benefit. It would have killed a lot of deals. It would have been terrible. Fortunately, we had one lone wolf out there that said no, and that stopped the whole thing. And our industry is very grateful. And so are a lot of other people. It's funny too, because so many people in Congress have self-directed IRAs. I mean, yeah, you'd think so. Yeah, well, what did Nancy Pelosi say,
We have to sign it, we have to pass it first and then find out what's.
Yeah, exactly, yeah.
All right,
Yeah.
any last questions in the room, guys?
Happy to answer any questions. I'll stick around for a while. Yes?
If you took the simple example where on your IRA and you buy a property, you have to manage that. If it's a rental, then you can't touch any of the money until it's time.
Well, right, so it's a great question. So first off, so your IRA acquires a property and it needs to be managed because you're gonna have renters. So you're allowed to do some certain things. You're allowed to pick up and collect the rent check that's made payable to your IRA. You can do that. You can screen the tenants, obviously select the property. And if any work needs to be done, you just can't do it yourself. You can hire third-party vendors. So in a lot of ways, you can be the property manager, but you also can't receive any compensation for doing it. So does that answer your question?
Yeah.
Okay.
You're doing all the work, you just can't touch any of the money.
Right.
Don't come in while you're-
Yeah. Those things you can do without crossing the line, you know.
And when can you touch the money?
When you retire. Actually, an IRA, a retirement account is always your money, so you can always touch it. I should say that. It's whether or not you're going to be penalized. So if you're under 59 and a half, you'll face in an IRA, you'll face a 10% penalty for taking it out early, like a penalty for early withdrawal, plus income tax. If you're between, say, 59 and a half and 72, you can take the money out without penalty, but if it's a traditional or a SEP or something or a simple, you'll take it out and pay tax, but no penalty. Yay. When you're in your RMD phase, the same thing. That says that you must take the money out, and you're still going to pay income tax if it's due, but you don't pay any penalty. So that's that. Great question.
All right, let's give it a hand, guys.
Thank you. Thank you to you.
Thank you very much.
Yeah.
So appreciate
Great to
it.
see you.